Hello, everyone. Thank you for joining today to the first RetireAdvisers Podcast episode. So this is super exciting. My name's Zach. I'm the CEO here at Pension Consultants. This is Michaela. Michaela, what do you do at Pension Consultants?
I am the Retired Advisors Manager, and what we do is we educate on retirement.
Super. So Michaela works a lot with our participants, with our retirement plans that we manage, oversees the team, has a wealth of experience and knowledge. So I'm kind of excited to dive into some of the topics that we have. So I think what we're going to do initially is we've got a couple articles prepared that we're going to go through, and things that might be pertinent to things that you've considered, seen in the headlines, thinking about, hey, how does this impact me as maybe a participant in a retirement plan, or if you have anything to do with the retirement plan at work. Hopefully that's helpful. We've also got our marketing team puts together some nice articles once a month. So we'll go over this most recent article called "Common Retirement Misconceptions That Deserve a Second Look." So that'll be super cool. Do you think there's any common retirement misconceptions out there, Michaela?
Oh, absolutely.
Perfect.
Sure.
I agree. Well, great. Well, why don't I go ahead and start off? We've got a few different articles, and hopefully we'll be able to share them up on the screen so that people can see them. And I'm sure we'll have links as well to these articles. I'm going to start off with the one from the Economist, and this one is called "The AI Productivity Boom Is Not Here Yet." And so I'll give a little recap and synopsis here, and maybe get some quick thoughts from you, Michaela. So the idea with this is AI adoption is obviously rising. It's in the news everywhere. I'm sure it's something that a lot of people talk about. But the main crux of the article is that you're not really seeing it in the productivity gains. So the piece had some data on AI adoption, and AI adoption is actually much lower than what you might think. It was sitting around, I want to say lower than 20% less than 20% for companies overall say they're using AI in any capacity, which I don't know about you. Is that a lot lower than what you would expect?
Honestly, yeah, that is really surprising.
Yeah, only 20%. It varies quite a bit by sector. So apparently information technology is the highest at over 40% adoption. And retail, construction, and food services, those are all some of the lowest. Oddly enough, manufacturing. That's kind of odd.
Yeah, more hands-on.
Yeah. Another interesting takeaway as well was just the productivity gains. So, I've read a little bit about kind of the personal computer revolution, and there was this puzzle during the 80s of all these personal computers coming, into the workforce, and how it's going to, spreadsheets, you no longer have to do things with pencil and paper and things like that. But it took more than a decade for any of that to actually show up in the productivity statistics. So that was kind of interesting. So we may be seeing a little bit of that here again. So the most recent productivity number from the Bureau of Labor Statistics was 1.9%. And that was pretty well baseline. Long-term average of about 2%. So no difference there. Kind of surprising, right?
Very, what I'm thinking about as you're talking about this, I feel like, you would think it'd be just a little bit different. Is it hard to, I guess my question to you is, can we really compare the bubble in the 1990s to AI?
Right.
So,
yeah.
Will it have a similar market trend?
Yeah.
It's kind of...
No, that's a good point.
Question.
Bringing up the 90s, because there was all, maybe you finally got some of that,
right.
productivity gains, and the market kind of got carried away with extrapolating that out to the future. So that, yeah, that's an interesting point. I even think about our own business. I think about your role. I mean, your team works a lot with people.
Yes.
But it's not so easy to think of how do we use this to continue to provide that great service, and not have these trade-offs with great service and these productivity gains. It's not as obvious. Like, I don't. Do you think of can you think of any ways maybe than just helping respond to emails every now and then?
That AI can help?
Right.
I mean, well, I think there was that nice little article that came out, I think, over the weekend about what AI could end up doing. And it sounds like AI could be doing even door dashing at some point. So, and it did talk about education. And I was like, ooh, that definitely could be my job. So, yeah, I think AI can really do a lot more than email, I think. But
Sure.
Like you said, when will that happen?
Right. Yeah. I think everybody sees kind of the long-term future of where this goes, but I think my guess is over the next several years there'll be a slow realization that it's going to take a lot longer to get there than what was kind of originally promised. So that's my interesting piece. Michaela, what do you have to share with us today?
Yeah, let's talk about the market. So I read a article from Morningstar, and the title is "Stock Market Concentration Has Surpassed Its 1930s Peak. Should Investors Worry?" And really, this piece is kind of showing the similarities of what happened in the 1930s to now. Something that I found surprising, and maybe I should have known, but the top 10 companies cover more than 30% of the market. Mm-hmm. And a lot of it is in technology, right? This one sector. Mm-hmm. And, what happens if something were to dip that market. And so I thought that was really interesting. So the question, I think the overall answer to, what if there is this big market downturn? How can you avoid that or participate in that downturn? And I talked about diversification. Mm. So
no, that's great. As I was reading through the article, that was exactly, and I think that's kind of one of the conclusions of the piece. But as you're reading through it, the thing that I'm thinking about is, well, if there's ever an argument for being diversified and not putting all of your eggs in one basket, and you as an investor, now more than ever might think, well, I'm in an index fund and I'm diversified, because that's the whole point of an index fund, right? But depending on what index fund you're in, it might be a lot more concentrated into just a few number of holdings than what you might think. And so, yeah, there's that interesting chart from comparing now to 1920s and 30s, and how it really hasn't been. Actually, it's been it's more concentrated now than it's ever been, but roughly about the same as back then. But yeah, good point to consider. How much do you have in small caps, for example? How much do you have in foreign equity and companies outside of the U.S. and all of those kind of asset class considerations? Probably matter a lot more now than what they did in the past.
Yeah. Absolutely. That's kind of what I got too. And I thought something else was kind of interesting was how much debt plays into these market downturns. It doesn't talk about 2008, but it does talk about, in the 1930s, there's a lot of credit. And same thing. I think it mentioned that margin accounts account for $1.3 trillion. That's a lot of things being bought, from borrowed money. Mm-hmm. So that was kind of surprising. I didn't realize how much debt plays a part into that.
Right. Yeah, I was actually talking with a colleague on a road trip back the other day, just on, he was asking about real estate and how important is real estate as an investment decision for a person. And it's kind of, one of the weird things with real estate is it's, if I wanted to invest in the stock market and I want to borrow a few $100,000 to, I'm going to borrow this money from the bank and I'm going to invest it all into the stock market. I can find margin loans like what you're mentioning, but like really big sums of money, it's hard to find. But real estate is kind of one of those unusual things where you can go easily borrow, huge sums of money and invest it in there. But with that leverage comes a lot more risk and a lot more exposure to even, relatively small downturns in the market. But I guess with the availability of credit, and how much more of a role in the retail investor is playing in the equity market. A lot of that, you used to only be able to make those highly levered bets kind of on your real estate. Maybe it's becoming a little bit easier to make those bets in the stock market now. But
like using Robinhood and all these other
based.
Yeah.
I don't know if you've seen we used to talk about the Wall Street Bets subreddit. There was like 2 or 3 years there where I feel like every time you turned on CNBC, they were interviewing some person from that subreddit. But it's kind of depressing sometimes scrolling through there, because you kind of see people that either through options or levered financial products, or just through large margin debt through these brokerage platforms. It's a little easier to lose everything using those levered products than it would be just through old school boring traditional investments. Really, really interesting piece. I think another important caveat, I think, with a lot of the historical analogies is that, just because you can draw the historical analogy doesn't necessarily mean, you might feel like, wow, I've really found something, but, just because it's happened once in the past and, in the past was a bad thing doesn't necessarily mean now's the time to let me sell everything because, oh my goodness, the market's going to crash just like in the 30s. But it is a good argument for diversification.
Yes, it is.
I don't know.
that too.
You meet with a lot of people, so do you feel like people need to hear that diversification story? Are people starting to put all their eggs in one basket in a way that maybe they shouldn't?
Yes. So I'll meet with people, and they'll do an index fund, something similar to the S&P 500, and they do feel diversified because it is invested in a lot of different holdings. Mm-hmm. But like you said, those holdings could be in that same industry, and if something were to happen, that's scary, especially for a portfolio that is supposed to be for the long term. You really want to capture all the markets,
right?
Because the market goes up and down in different sectors.
Mm-hmm. Yeah, I think because the markets have gone up for 3 years, in a row of just like incredible, way above trend returns. Like, we're meeting people every week that are like, hey, I'm getting ready to retire, and I've got 95% of my money in, NVIDIA or, these big cap tech names. And I really wish I could encourage. Well, we can. I do. I wish I could encourage more people to, if you're in a position like that, you're getting ready to retire, retirement's, coming up in the next 5 to 10 years. Like, now is a good time, more than ever, to really get out there and diversify your portfolio, and not have it concentrated just within one little bucket.
Yeah. Don't be too aggressive. Don't be too conservative. Because you don't want to be on the other side of that too, when you're like all into super conservative funds like bonds and cash. Mm-hmm. So still play in the market, but just be diversified.
Yeah, that's a tough balance to get. Well, let me jump over to my next piece. I thought it was topical to talk about the tariff refunds after the Supreme Court decision. I imagine you've seen that the Supreme Court struck down IEEPA. So they're basically have ruled that the Trump administration's use of the International Emergency Economic Powers Act was unconstitutional. And so one of the interesting, takeaways from that is, okay, the Trump administration can't use that to as a justification for tariffs. They can still implement tariffs, but they have to find another justification for it, which they're currently doing. But the big, I think, almost as large of an economic impact of do we have tariffs in the first place is what happens to all of the tariff money that was collected on the first go around. And it seems like at the moment, we're just gearing up for 2 to 3 years of litigation and lawsuits, and that money will slowly trickle back after the lawyers have got their fair share. So do you think a lot of people ask about tariffs? Is that at the beginning of 2025, that was a big topic of conversation. Are people still asking about that
Right.
quite as much?
Honestly, no. You're right. That was a big topic. Some thought it would be good. Some thought it wouldn't be so good when it comes to the market. I think there's less concern about it. Now, the question that I think I want to propose to you is, if we do get a lump sum of money, maybe something similar to 2020, what should we do with it?
Right. That's a great question. Well, if you have debt, and if you have some of this high interest bearing debt, the government gives you money. I know I always try to make a habit of, it's like tax refund time.
Right.
What are you going to do with this? Well, pay off, put it towards the house or the car or something like that. If you're sitting on like one of these 1%, mortgages or loans, maybe don't do it there. Maybe save it somewhere else instead. So yeah, pay off debt or invest it. Save it. That's my vote.
I love that.
Seems fairly fair. Yeah, it's a interesting time. One of the things we've been talking about on the investment team with tariffs is, what's the inflationary impulse of the tariff? Because here, let me throw a paradox at you.
Okay.
Most people agree on some level, you implement tariffs and it is inflationary, right? Almost by definition.
Right.
You impose the tariff, the price of goods go up. Again, almost by definition. So tariffs, therefore, are inflationary is kind of the traditional way to think about it. Well, so the government collects all that tariff money, and then they're going to send all the tariff money back. Well, that's also inflationary, right? Because if the government just, we tried this during COVID, the government sent everybody a bunch of, refund money and the price of everything went up. So what's the how do we get out of the paradox?
Yeah, I think I've been reading a lot about inflation. I think it's a very interesting time. I don't know. You tell me. I don't know. I don't really. I know that the feds are trying to lower. I think at one point did lower a little bit, or they were planning to in January, right?
Right.
Yeah. I don't know.
Yeah, it's a puzzle, isn't it?
Yeah, that's interesting.
It might. I know we're like treading. I got to tread very lightly here because this is stuff that people have strong opinions on. But it may be that there's like a monetarist take on tariffs, which is monetary theory is you get inflation from a change in the overall currency base. So if you print dollars, obviously you get inflation. You take away dollars, you get disinflation or deflation. So from that lens, you would look at, well, tariffs maybe aren't super inflationary if they're maybe smaller in quantity, and maybe it depends on what kind of goods and services they are too, because you might spend more here but maybe you spend less somewhere else. But we're also running these super huge fiscal deficits, so the government is possibly offsetting if you have inflation over here, maybe excess government spending is offsetting it somewhere else. But I don't know. It's an interesting puzzle. I don't have anything all that intelligent to say about all that. Cool. And then one last piece. What do you have there?
Yeah. So during the State of the Union, President Trump brought up the fact that he wants to, start allowing a kind of a federal 401k retirement plan. It's going to be very similar, based on what he was saying, to the thrift savings plan.
Mm-hmm.
And so when I listened to that, my ears perked up, because that is obviously the industry that I'm in. And, what I didn't realize is that 50 million Americans that do have access to retirement are not utilizing it. So I thought that was interesting. I think originally the idea is this plan to be for individuals that might not have access to a retirement plan, but it's going to be a while before that's rolled out. And so right now, what do you think someone that does want to start saving for retirement, if they can't wait for that thrift savings, similar retirement plan,
right?
Is it just an IRA of some sort?
Mm-hmm. Yeah, it's an interesting point, and a lot of interesting proposals for people that aren't covered by a plan, and kind of the impacts of that, and what that might mean for Social Security. Those are all kind of big, important questions that are floating out there. Right. I read it and wondered, could the government switch from kind of a defined benefit Social Security model to one that is defined contribution? As the government, we're not going to tell you how much you get, tell you how much we put in, and you can do with what you want there. Who knows politically if there'd be anywhere near enough
I don't know if that's going to have
like
a
that.
lot of fan there for that.
Yeah, certainly. But yeah, to your question, if in the meantime, if you don't have a job, or you're in between jobs or something, and you still or your company just doesn't have a plan or have a good one, absolutely, an IRA is a great place to go. And there's limits, there's contribution limits, there's you don't get a match, so those are the downsides. But you still get, if you if you do a pre-tax, you still potentially can deduct that from your income at the end of the year. If it's Roth, that's a great opportunity, because that's just simply tax-free growth. And so, it's always going to start with, you want to save in your retirement plan at work and get the match if you've got it. Then, their Roth and traditional IRAs are going to be the next bet. And then the thing I think people don't think enough about is you can always do a taxable account. If you've exhausted the other options, or for one reason or another and they're not an option, there's nothing wrong with opening a taxable brokerage account, putting some money in, because that's, again, better than nothing.
Right.
So, yeah.
Right.
You have any different take on that?
No, I completely agree with you. And I want to bring up, something because this is referencing an article I read, with this new retirement option that Trump is talking about. You can have access to it when you do your taxes. There's a box that you click. Mm-hmm. And, you can do an IRA right now. But I think a lot of people don't know where to get started. And so, and I know you were asking me about the brokerage. Do I think that's a good idea? I do think saving money in any capacity is going to be a good idea. But I think, how do people go about opening an IRA? Is it just with their bank, or just any financial institution?
Yeah, I know. As you were talking through that, I was thinking, it's like, well, the easiest way to do that is you can go on your phone and you can use Robinhood, or these kind of gamified apps, but they're designed to encourage you to gamble your money away, because they make it so easy to play with the options. Or
goes back to the first article I talked about.
Just go ahead and pick those high-flying tech stocks, because the mentality you get into is, if you're starting out, you start with $1,000 saved, and that turns into 5, turns into 10, and if you think, well, goodness, if I take all of that, and if I can just pick one of these crazy names that goes up 500% in a year, I'm going to be rich. Like, I can quit my job. You start to think about all of that. And, but the probability that that's going to go well is very low, and the probability that it's going to, blow up in your face, and your account balance will run to zero, and you'll be one of those folks on Reddit I was talking about, is unfortunately very high. So I'm a fan of kind of your more boring, IRA brokerage platforms. I won't necessarily name any names, but the ones that have been around for a long time, that aren't going to encourage you to gamble your money away, and just invest into boring old ETFs, mutual funds, index funds, good actively traded funds, and do it the old school boring way, as opposed to trying to get rich quick or something.
Right.
So
that's really good. I always say too, when I'm talking about the funds that are offered in the retirement plan, a lot of them are mutual funds, and ETFs are very similar. And so when you are picking and choosing, it's really looking at the objective too of these funds. I just want to throw that out there.
Right. Yeah. Yeah. Because mutual funds, they have their prospectus objective. And so, yeah, it's important to go through and read that, go through the website, understand what are they actually invested in, what are, what's at risk. Good point there. Well, let's now transition to our main topic of the day, which are common retirement misconceptions that deserve a second look. And this will be fun to go through because we can kind of go through each one that's listed, and I can get your take as as an expert that's spent a lot of time talking with people that are either just getting started within the plan, getting started thinking about saving, and also people near the end of retirement. You get to see, what have people done well that's led them to maybe some point of success, and what have other people done that where maybe they could have made some better decisions. And so we'll just kind of go through the list here, and I'll get your quick take, Michaela. All right, so number one, I'm too young to think about retirement. Well, how common do you hear something like that, or how prevalent do you think that is? I'm too young to think about retirement.
Yeah, I think it's actually very common. And I don't think it's because they feel like they're too young, but maybe they feel like they just don't have the income that's coming in.
Mm-hmm.
And what I like to point out is just saving any amount is going to be beneficial. So even if it's 1%, putting it towards your retirement, that's going to grow, it's going to compound, it's going to be returned. There could be a match. But also it's a good reminder that retirement hopefully will come at some point. Because when you don't start and and I see this a lot, it's like, maybe they come in and they're 18, but they end up staying 5 years. Well, they just had 5 years in which they could have gained a match or contributed and really gained some wealth by just putting a little bit away.
Mm-hmm.
And so, knock on wood that everyone gets to that point in their life where, retirement is going to happen. And for the majority of us, that is something that will happen, right? We're all going to age. So you're never too young to retire. Or
get started.
Get started.
Yeah, no worries. Totally agree. And I've I think about my wife, Rachel. Hi, Rachel. She got started right out of college and worked at an insurance company. And she started saving right away. And her first job out of college was not a super high-paying gig. It was she was a compliance analyst. And I thought I'd be creative, in my career, and I'd experimented with starting my own business, and part of that was liquidating my 401k at the time so I could finance that. Turns out it's great experience, not the best financial decision. And I've been able to see my she I don't remember the exact timeline when she stopped working, but at some point she stopped working, and I've been working to catch up to her account that she started when she was 21, and then I started because I basically started over much later. And so I've been able to see this in real time. I mean, it's a ridiculously unfair advantage if you're able to start early. And I'm somewhat conflicted on, do we talk about this with participants, because I don't want people to think, well, I didn't start when I'm 21. I'm in my 30s or 40s now, and shoot, oh well, maybe I don't need to start anyway because I missed out.
Yeah.
So I'm worried people have that effect. But the important takeaway is, no matter how old you are, you'll look back 5 years from now and wish you would have done a lot more than what you did.
100%.
And you would have prioritized it. And so whether you're 21 starting out, you've got to understand this game is so easy if you start today. Right. And if you're in your 30s, 40s, 50s, and you're looking back and saying, I wish I would have saved more, well, you'll still think that 5-10 years from now if you don't take it more seriously today as well. All right, so my target date fund means I'm covered. What do you think about this as a common misconception? Obviously we spend a lot of time thinking about target date funds and how prevalent they are. Is there maybe a certain life cycle or stage in life where maybe it's easier to use a target date fund, or when should I maybe start thinking more about my investment allocation?
I think you should always think about your investment allocation. Target date funds are really good for someone that is hands off. They want it, a portfolio that's strategized for their retirement year. However, depending on your tolerance, if you're really aggressive, maybe you're a little bit more conservative, that target date fund might not match with your tolerance or capacity. I do think a target date fund is really good when you start out into a retirement plan, because when you're getting enrolled, it can feel a little overwhelming. And being able to take some time and really start understanding investments, looking at the prospectus, looking at the objective of funds before making changes, is important. But if you are wanting to be a little bit more hands-on, then the target date fund won't necessarily allow for that.
Sure. That's, I think you mentioned starting out. Target date funds are like the ultimate getting started tool. The most important thing is how much do you have saved and how much are you saving? It starts there. It doesn't matter what your risk level is or what you could return if you don't have anything or you don't have enough saved up in the first place. But for people nearing retirement and are thinking about retirement, it becomes more important to consider what's my goals? How do I want to finance my retirement? Is my allocation appropriate to give me the return I need, balancing with the risk that I'm taking on? There becomes there's a bigger orchestra that has to be managed at that point. And so for 80% plus of people that have a very simple structure, target date funds probably give them mostly what they need. But there might be some optimization or more complicated discussion as you kind of approach retirement.
I agree. And it probably also depends on your capacity to take on risk, because target date themselves do become more conservative throughout retirement. You may be able to afford to be a little bit riskier to gain those returns. Mm-hmm. So I think that's right, especially if you want a certain type of lifestyle.
Right. Yeah. The experiment I run with people, we have some scenario analysis tools, so you can see, okay, let's rerun 2008. Based on how I'm allocated now, what would my portfolio do hypothetically during a time like that? That's the kind of thing you need to be thinking about, as you get closer to retirement, is how much risk am I taking on? Obviously, if your portfolio goes up 20% right before retirement, you're thinking, woohoo, that's great. If your portfolio goes down 30 or 40% right before retirement, that could just be a showstopper.
Right.
And so if you're in the right target date fund, your risk of that's lower, but it becomes more important to at least let's look at how we're allocated. Let's look a little deeper than just simply the set it, forget it kind of approach there. All right, moving along. I'll catch up later. Surely this is not something you've ever heard, Michaela. Do you think a lot of people out there are thinking to themselves, hey, a little behind, but just give me some time. I'll catch up later.
Yeah, and this isn't just because it is kind of similar to, hey, I'm too young, I don't need to plan for retirement. But I'll catch up later does also apply to individuals that are older, 30 and 40. Maybe they want to spend their money on, a boat or a vacation, and we'll save more for retirement later. And there's a it's a value thing, right? What you value. But the potential of putting money away now, like you said earlier, you know, it's limitless in a way, right?
Mm-hmm.
And so definitely a misconception. If you're able to save more, save more.
Right. Are you going to get a boat? Are you a boat person?
I'm not a boat person.
Not much of a boat person.
I could be I'm not a lake person. You know what I mean?
Yeah.
A boat on a beach, not that different. But.
Yeah, that's fine. Yeah. A boat is like you're on a beach, but you're trapped with other people. It's kind of how I view it.
I can see that now that you said that.
Right.
But I think like, I'm away from people.
Mm-hmm.
You know, just different perspective.
Yeah. But that's what saving for retirement's all about. You got to figure out whether or not you want to get a boat. All right, Social Security will be enough. I'm not sure if I seem like the Social Security questions that get asked the most are, will it even be around?
Mm-hmm.
But maybe do young people, do you feel like they're worried about Social Security, or do they think Social Security is going to cover them? What perceptions do people have about Social Security and how far it'll take them in retirement?
Yeah, I don't know about Social Security being enough, but will Social Security be there?
Mm-hmm.
And that is a really good question to ask yourself. I do think, this kind of changes the subject, so we're talking about this article, that Social Security will be there in some type of form, right? But I think, there's a really good chance that, we could be getting a lot less in Social Security.
Mm-hmm.
And so if you are out there and you are planning for Social Security to cover most of your expenses, I do think that there's risk associated with that.
Mm-hmm. Right. Yeah. If that ever comes up in conversation, with somebody, it's, you think through it. Well, what can I do about it? What do I have in control that I can actually affect? And it's probably saving more. That's the unfortunate answer to everything. I'll just work longer. Probably not one that anybody's super excited about, but could be something way in the back of your mind you're telling yourself for not dealing with it seriously enough.
I actually heard that a lot. Like, I don't plan on retiring. I'm gonna retire until I can't wake up in the morning. You know what I mean? But I also see when that doesn't happen. So, and I talk about the story a lot. I met with a woman last year. She was 62 years old, and she was a nurse. And a lot of nurses, they work for a very, very long time. So she was not planning on retiring.
Mm-hmm.
When she came in, she said that her son recently passed away, and she had to retire. And because she was able to save, when she was younger, she was able to do that. And so you could have these plans of, working until, your last day, but the uncertainty is what you'll want to save for. And that's just, you have to think about physical ailments too. I mean,
Mm-hmm.
as we get older, we're not able to, physically work sometimes.
Right. I don't have any stats I can throw out here just off the top of my head, but I think a lot of people would be surprised by the percentage of retirements that are somewhat involuntary.
46% retire before they plan to.
Well, there you go.
There you go.
I think we should switch seats next time. 46%. So yeah, that's a very large percentage. And there's all sorts of ethical and legal debates you could have about, do employers force people out or encourage them out or anything? We don't need to wade into all of that, but just simply the thought experiment of, well, what if you actually aren't able to work for one reason or another, health, employment considerations or otherwise. And so I think for a lot of people, whatever year you're planning to retire, if it's an age or whatever, it's more likely than not, it's going to be a few years before then. Most people aren't, for one reason or another, aren't able to make it all the way to 65 or 67 or 70 or what, whatever that idea is. So that's really interesting. Spitting facts. Nice stuff, Michaela. I don't make enough yet for planning to matter. So maybe I'm starting out and just, I'll make more down the road. I'm not making much now. Let me just cover my groceries and, whatever else. And 2 or 3 years, I'll be making enough. I can start saving at that point.
Right. And going back to what I said earlier, just putting a little bit away will make a big difference. But yeah, I do hear similar stuff.
Mm-hmm. Yeah. I don't need to review my plan until I'm closer. So, I personally have met several people. In fact, I can think of one that I met with this year that, basically retired, put notice in. I think I've got enough, but hadn't actually worked out the details of whether or not it is in fact enough. Thankfully, it was enough, but that was surprising to me. And have you encountered a lot of people in similar situations?
Yes, like they'll go, I never look at my statements. I set up my investments like when I started, and I've been here 30-something years, and I thought I should take a look. And sometimes, no, just based on luck, that does work out. But if you set up your investments again to be in one type of fund, and then that fund doesn't do too well, then that there's a good chance that that's not going to be your story. Right. So definitely always, I say, we have an income needs analysis where we look at how much you're currently saving, how much you have saved. And I say at least do that, even if you're far out, every 2 years, and then as you get closer, once a year.
Mm-hmm. Yeah, I completely agree. I mean, there's no reason not to. I mean, it's,
right.
You are running the numbers of, if I do this for however many years, I should get to here. Right. And that should be enough or not enough. And you can make changes now, before, once you get to, retirement, it's a lot harder to make changes at that point. The changes might be something like downsizing or, liquidating assets or something to that effect. And that's not fun. Retirement planning is just about investments. Kind of tying into that previous point too, where you mentioned I'm in a good fund, and that's good enough. What does that miss? What am I not doing if I'm just looking at the investments?
Right. I think there's 2 important things to think about when it comes to retirement. There's 3, but there's 2 main ones, and one of them is investments, but the second is how much you're saving. Mm-hmm. So for most people, you want to save 10 to 20%. But you need to start thinking about what you want your retirement to look like. And that should inform your decisions about your savings. And so, and then pre-tax and Roth, that's another thing to consider. But retirement for sure is a lot more than just investments, and also estate planning too.
Mm-hmm. Yeah. All right. Last misconception. This is totally tied into the other one, but my investments are performing well, so I must be on track. So again, I think you summed it up perfectly with, there's, when you're enrolling into the plan, you've got, how much am I saving? Am I doing Roth or pre-tax? That's a total optimization question. That's not a foundational type question. And then it's my investments, and so if I don't save enough in the first place, doesn't matter how well my investments perform or don't perform, because I should have put more in. So you've got to start with saving, putting money away. The secondary consideration is making sure the investments are performing well and right for you. Perfect. Well, thank you so much, Michaela. This was fun. First episode, and appreciate you all for tuning in today. Feel free to connect with us on our website, RetireAdvisers.com. There's a schedule button. You can schedule time with one of our consultants. Maybe you end up scheduling time with Michaela, and check out our other resources and things. But keep an eye out for the next episode and things from here. But my name's Zach. This is Michaela. See you all soon.